Now we're going to turn to Europe, and some of the data did get a bit better, but it also creates a bit of a problem for the ECB, or realistically allows them to continue to raise rates, which is something that I think is a very common thing that's going to happen. And we'll talk about where we think those rates are going to go. But it's important to highlight something specific, especially for those that are from the States and you're used to a 30-year fixed mortgage, or that is a common thing that you hear about. In Canada and in Europe, most things are actually under ARMs, or adjusted rate mortgages, and they're typically 5 to 10 years. So as the ECB pushes rates higher, you're going to get more pressure because they either restrike quarterly, every 6 months, or every year. So the mark to market on an ECB raising rates is going to be painful. Now, it is expensive to own anything in Europe. So a lot of these individuals that own their homes, or, typically you'll buy your home outright and then leverage to buy 2 other homes to then rent out. That's going to be expensive. And that's going to hit some of the higher end more than the lower end. And again, when you think about income levels, and they're going to have to raise rents to cover the additional cost of the ARM rate mortgage. So that's going to be an interesting dynamic as we go through the year to see how does that impact spending. So when you look at M3 supply, it was expected to be up 5%, was up 4.8%. So again, still seeing that slowdown. Eurozone manufacturing was expected at 47.8, came in at 47.8, but services was much better than expected to be at 49.1, came in at 49.8, just below expansion. But for those that have been watching us, we've been saying that anything between 49 and 51, you're a little bit up, a little bit down. So there's not a huge adjustment. And then on the composite side, was expected at 48.8, came in at 49.3. So you're still seeing contraction, just not to the same degree. Then the question is going to be what happens next when you look at January into really Q1 as you get some of these adjustments. Now, as we said with the US, we just think it comes down a little bit, but we're not going to get this huge collapse. It's just more of a very steady contraction number where, services will likely slow to 48.5. You'll likely get composite down to 48 now, but you're just going to be bumping along the bottom at this point. And Germany is giving you some of those indications. When you look at manufacturing, was expected at 47.4, came in at 47.1. So again, things still remain a problem in the German markets. CPI slightly better than expected, came in at expectations were for negative 0.6, came in at negative 0.8. When you look at the harmonized view, was expected at negative 8.8, came at negative 1.2. Still elevated, but you're starting to see some of that peak. And again, commodity prices have come down. You've seen a lot of warmth there, so that has been good for reducing the amount of natural gas they need, which has brought TTF down, which has maintained storage. But those are some positives. Now, import price index was expected to be at negative 0.7, came at negative 4.5. Another positive for passing some of that through. German services, PMI was expected at 49, came in at 49.2. Composite was expected at 48.9, came in at 49. So you're still seeing some of that back and forth, and this is where we think we bump along. Now, but similar to the U.S., similar to other areas, we don't see this massive collapse in inflation. We do think it has likely peaked, and now will go more sideways than it will straight down, and those are some of the places in which we deviate from others. Spanish retail sales, negative. We see that slowing down again. CPI actually went back up. We see some of that growth in general when you look at where CPI is going to be and inflation will be in Spain. Spanish manufacturing PMI expected 46, came in at 46.4. So that's something that we think is going to be fairly stable because Spain is, again, going to continue to struggle on the manufacturing side. Services, though, is going to remain stronger. So here, services was supposed to be 50.7, instead came in at 51.6. Composite coming in at 49.9. So you're getting a little bit of that benefit where services are better, manufacturing is worse, and that's where we're going to live. In Spain, the question is going to be how soft do the services get? And that's really going to drive where the composite will be. But in short, it's going to be in a net positive spot for the services side. On the French side, manufacturing was expected at 48.9, came in at 49.2. CPI surprised to the downside, expected to be up 0.4, came in at negative 0.1. And then for just France was expected at 6.5, came in at negative 0.1. So again, you still have inflation. It's just not as bad as expected. And some of that disinflation that we've been seeing and talking about. Composite services PMI much better than expected at 48.1, came in at 49.5, putting the composite well above estimates at 49.1. So still contracting, but you got a nice bounce in December as you had way more travel, you had more activity, and again it showed up in the services front. Manufacturing not as much of a pop, but again, the services is where we're seeing some of the staying power, still contracting, but not to the level that it was. Now, when we go forward, again, as we've been talking about with manufacturing data, the order side still continues to be a problem, which is why we expect to still be in contraction, just not at the extent that we were after those lows. Italy, slightly different. Expected to be manufacturing was expected at 48.6, came in at 48.5. Composite services expected at 49.5, came in at 49.9, putting the composite right at 49.6. So again, services still remaining the bright spot as manufacturing is the overhang. Now, the Euro area labor cost index was up year on year, coming in at 3.2%. That's going to continue to get worse. Because again, same thing, you have rates going up, you have rents going up, you have home mortgages going up. So you're going to see that labor, because wages will have to track that to a degree, again, not one for one, but again, it puts more of that upside pressure. Global Eurozone manufacturing PMI, again, the bounce, but you're still just bouncing along the bottom, which you're still in contraction, and we still see that being the fairly common kind of backdrop when you look at manufacturing in general. M3 supply, again, moving lower, but we still need to see more activity and more of that move to the downside. Eurozone business loans, starting to roll over a bit, but still remaining elevated, and they need to see that drop more because you need to see some of the liquidity drop out. You need to see some of that pressure being removed from the system. Government bond yields, this is as of December 22nd, so they've been moving around a bit, but you see that the move is still elevated, it's still high. And then when you look at the survey for year over year inflation, expected at 10.2, came in at 9.6. And we do expect that to come down, but the slope is going to level off a bit, and we're going to continue to be in that inflationary backdrop. Core inflation isn't rolling over, and that's the biggest piece that we've been talking about, because yes, you'll get some of that drop, but services was much better than expected, still contracting, but services is a key piece of the core and sticky side. On the rent side, on the mortgage side, because they're tracked to ARMs, you're going to have a bit of that pressure that we don't experience the same in the US, which again is going to keep some of that pressure on the core side, not only just in Germany, but in other areas. Now, inflation in the euro area with the dispersion, you can see that things are still moving higher. You still have a lot of stuff that is getting more expensive, not to the same degree as it was, but still moving in the wrong way, which is why we still have some of that support for that inflation. And as we've been talking about, some of that core inflation, sticky inflation, which again, as we talked about in the US, also holds true to Europe. So that's what we have for you on the European side. In the next segment, we're going to go deeper into China and how things closed out and where things will go as we head into the new year.